Hello, Money Show audience. I'm Kate Stalter, hosting the videos today. I'm with Better Money Decisions, but today we are at the San Francisco Money Show, where they're featuring the Women on Wealth panels. I am so happy to be joined today by Catherine Avery, who is the principal at Catherine Avery Investment Management, CAIM for short. We just go by that. And Catherine and I were on a really great panel this morning, and you talked a little bit about asset allocation, dividend reinvestment. You know, we're coming up on 8 years, more than 8 years now, of a bull market. And talk a little bit about what are some of the asset allocation strategies after a lengthy bull market that you use with your clients in order to kind of protect and grow their wealth.
Right. Well, I would say even during the bull market in and of itself, you know, I always tell people that whatever money that you need for the first 1 to 3 years, that's something that you should really protect and keep in cash, whether it be CDs, money market funds, savings accounts, something that's easily accessible for you. Because, you know, we never really know when that turn is going to come, and bull markets could go on much longer than we ever really think.
Right.
Okay. And I think right now the indication is that, you know, the valuations are bumping up their highest levels. But, you know, there's a lot of good that's going on right now, too. I mean, we're looking for tax reform, we're looking for healthcare reform, and with those kinds of things in place to help propel growth, this bull market can continue to go. You know, as you know, on Wall Street, they say the bull market climbs a wall of worry.
Right, I've heard that, yes.
So, you know, we just don't ever know when it's going to happen. So asset allocation is really key, making sure that you keep your short-term money in place in something that's very, very safe, and then taking the rest of your money and investing it for the longer term, whether it be stocks, bonds, something that's going to give you that growth and be able to help you outperform inflation over a long-term period of time.
Now, one thing that you talked about in our panel earlier today that I found really informative, I totally agree with, the idea of dividend reinvestment, because a lot of people, when they just think about stocks, they're thinking only about price appreciation and not the extent to which dividends contribute to their total return. So say a little bit about that.
Well, actually, Kate, it's interesting, but since the 1930s, dividends have actually contributed 50%, if not more, to the total return in stocks. Most people really don't realize that, because we went through that whole period in the 90s where all we saw was stock appreciation. Nobody was increasing dividends. But after 2008, with the financial crisis, things started to change. Corporations got very conservative. People were hoarding cash on their balance sheets. And there's a lot of great companies out there that they have low levels of debt, they have strong cash flow, and they are paying dividends and also increasing their dividends, sometimes greater than the rate of inflation. And as we live longer as baby boomers, that becomes more and more important. Because it's great that the stock price goes up, but it's got to be able to go up in lockstep, if not more, than inflation. And the dividend-paying stocks offer a little bit more of a conservative way to kind of play that investing in equities. And it takes us back from having to worry about the day-to-day, as you even said, noise in the market. We always have noise. But the dividend gives us a comfort to know that even if our stock goes down, we're still getting that dividend cash into the portfolio. And we can either use that to supplement our income or even take that cash and buy stocks at a lower price.
So I think, though, I agree with what you're saying 100%. One thing I wonder about is, aren't we kind of in a different era? I mean, I remember when maybe in the past people would talk about, oh, you want good dividend stocks. We also do need that growth element too, don't we? I mean, it's a mixture of both. I think that is what you're saying. But just elaborate on that a little bit more if you can. I'm thinking that dividends are probably not enough the way maybe our grandmothers might have thought. Right.
Well, the dividend is actually not enough. Okay. But for example, in our portfolios for the past 7 years, the average annualized return has been almost 14% a year. So you are getting that the dividend yield on that is probably about 3%. So yes, you are going to participate in the up markets. Maybe not always as much as the broader markets or the S&P or growthier trends, but you will still participate in that upside. So you're not really eliminating the growth, but the way I would categorize this as a growth in income type strategy, because we're not just looking for stocks that pay high dividends. You want to make sure that there's enough to pay that dividend, grow it, but yet for the company to have enough of that cash flow to reinvest back into the business, so you get that growth in the earnings and therefore the growth in the stock price.
Right, and this is why it's so interesting, because we were on the advisor panel, and I think some of this is hard for people to do on their own, isn't it?
Yes, yes. They don't know how to decipher through that. And again, I think you're right. I think the bias is always when somebody says dividends, they're thinking high dividends. They're thinking companies like AT&T. They're thinking of the Philip Morrises of the world. But there's a lot of great companies out there that pay what I would consider to be average dividends, like a McDonald's or a Cisco Systems that still has growth in it, but they're not as high paying dividends. So it's really important to look at all those things I talked about, the debt level of the company, their cash flow, how much free cash flow are they providing to you, and what's their going forward, what their needs are for capital expenditures, how much are they putting back into that business again to grow the business, which is really key.
A lot of great tips here. Thank you so much,
Thanks,
Catherine.
Kate.
Really great you were able to join us today. Thanks everybody for watching.
Thank you.